Another big and important part of this personal finance course is investing. And first of all, I would start with a disclaimer. This is a personal finance course, and I cannot cover in a huge topic about investment within, like 30 minutes inside this course. We can talk all the 5 hours only about investing and still have only scratched the surface of it. So everything you will see here is very basic understanding that you need within the personal finance realm. So I hope you don't expect to see a video how to be a surgeon in 15 minutes. It would be stupid. The same is here. Being a market trader, investor, investment advisor is also a real job, real occupation. People study for years about it. Also, there's a huge luck involved there, so not necessarily studying helps, but it's a real profession, so it cannot be explained within 13 minutes or even 5 hours. So I just want to manage your expectations, what we would talk within this part. So it would be just the basic concepts and everything, try to keep you playing on the safe side. Now, if you have played in your childhood Monopoly game, I think many of us have played, you remember there was only one winning strategy. Whenever you have your move, and if you have the money and you have the opportunity, buy the yielding assets, buy any of the assets that are producing the income for you. The player that has most of the assets, if he owns all the street, basically he wins. It was maybe not interesting game when you understand it from the gameplay perspective, that all the time you don't need to think about any of the strategic logic. If you can buy, just buy. It was maybe as simple as that. But it made one very particular point that we spoke about in the initial concepts. When we spoke about the rich dad and the poor dad. Rich dad owns assets that are generating income. The assets that are active, assets that are producing income. And the poor dad is owning assets that are even dragging more expenses out of his pocket. So save and invest, that's basically was the strategy for Monopoly game, and that's the same for all this investing topic. Once again, I want to remind you the importance of starting early, and here's the same example that I'm showing 3 or 4 times during this personal finance course, that the earlier you start saving and investing, the bigger nest egg you would accumulate, the bigger positively yielding asset you would generate over the years. And you can just check how big is the difference. What I want to stress and what I want to show you about, definitely after 50 years, saving $5 or $10 per day generates just for the $10 just 2 times bigger capital, bigger asset at the end of the period. Yet saving $5 over 50 years or saving $10 over 40 years, $5 wins a lot, nearly $1 million. So time matters, and the earlier you can start, the better. Now, what are the options for you to save? Basically, you can store cash under the mattress, but then the cash is not growing, and because of inflation, purchasing power goes down, and all your savings, it's good that you are saving, but technically the purchasing power goes down. So here are all the method of savings that are generating some additional income, at least some additional income time by time. First of all, that's the saving accounts or certificates of deposits. That's when you take your money to the bank and you agree that you won't touch it, for example, for half a year or a year, and the bank gives you in exchange some small interest when you would withdraw that money. That's fine, but the interest is small. And also what you need to understand, bank is not keeping your cash totally like in a vault. It's just lending it to somebody else. Like that old saying that the bank, buys money from you for 3% and lends it to somebody for 6%. That's basically how banks are doing the business. So very theoretically, if there's a run on the bank, bank would not have enough cash to return to all its depositors. And if bank is managed poorly, bank might go bankrupt. Luckily, nearly all the countries have some insurance for the banks, and if you are not holding their millions, your deposits there are insured. So next option is the government bonds. Government bonds is very simple. You give your money to a government, and government promises to return the same amount of the money that you gave to them after, let's say, 1 year or 5 years or 10 years. And the government pays you interest, or the cost of money to you every year, pays you back until, let's say, on the year number 10, returns you the all the loan back, the borrowed amount. Government bonds are considered to be as safe as the government itself. So probably if you live in States or in any of the European countries, that's very safe. Also, then there's a corporate bonds. Corporations are judged as less safe entities as countries, yet maybe Apple, as an example, Apple company is definitely bigger, in the monetary terms, a bigger company than some mid-sized European countries. So corporations can also issue bonds. They can borrow money from people, promise return the borrowed money back after, let's say, 5 years, and they pay interest on that borrowed money. Then there's stocks. Stock is owning a part of the company, let's say having a same one Apple stock, owning a very, very, very tiny amount of the Apple. And if the company decides to pay dividends to its shareholders, you as a super minor shareholder also would get your small share of the dividends. And also over time, if the company's value goes up, basically your value of your stock goes up. And if you would sell it, you will get additional income. So then there are funds, which is like more mixture. Imagine a salad made out of stocks. So it can be mutual funds, hedge funds, ETFs that we will talk later. And that's what I recommend for totally beginners, is not picking any individual stocks, but buying this collection of the stocks within a ETF or within a fund wrapper. It's like a salad made already for you. Then there are commodities that usually the market traders usually trade. That's the gold, oil, wheat, cattle, corn, and so on, so on, so on. So that's the basic things that are used in the food and manufacturing industries, but people are speculating on this. And then there's real estate. It can be apartments, it can be houses, homes, and so on. Also, there are currently very many peer-to-peer lending platforms where you can lend your money to other people. And finally, not finally, but nearly finally, there are financial derivatives. They are called futures, options, CFDs. I'm just saying that they exist within this investment domain. You just need to know that they do exist, and that's it. And that's my saying, you as a beginner just don't need that. Finally, there are also startups, cryptos that you can also invest into that. So, and I tried to rank them from the risk point of view. The saving accounts is the safest, and the least, let's say, return generating saving type, up to startups or cryptos or some crazy other speculative ideas that potentially might give you a very big return.